Let's turn now to Mohamed El-Erian. He is, of course, the Chief Economic Advisor at Allianz. Mohamed, always great to see you. Thanks for joining us tonight.
Thank you, Bill.
What, in your view, is the message of the U.S. stock market right now when you bear in mind that treasuries, long-term treasury yields are close to two-year lows, and now, following the Osaka summit, we still have tariffs, 25% tariffs, for the foreseeable future? Why are we at an all-time high right now?
For three reasons. One is the truce, or I like calling it the ceasefire. Things won't get any worse. Second, the Huawei news was a surprise to the market. So that suggested an easing of tension that goes beyond the headline of the ceasefire. And thirdly, it keeps the Fed in play, meaning that because the uncertainty hasn't been fundamentally lifted, the Fed is likely to cut in July. So the markets like the ceasefire because it calms things down without taking away the Fed rate cut.
Are you surprised, though, at the lack of volatility that we've had just recently anyway, Mohamed? I mean, I'd say about 3 months ago, every time we got a trade headline, we were either up 100 points or down 100 points. And we've seen a lot less of that.
We have, because there's been a major pivot on the part of central banks. The four major central banks have all indicated that they're going to stimulate more. And the markets have been conditioned to respect liquidity from central banks. So the more the central banks are willing to decouple the markets from the underlying fundamentals, the more the market does that for them. So it doesn't really surprise me. What also doesn't surprise me is the economists aren't that excited about what happened over the weekend. They tell you the basic uncertainty isn't gone. Companies are not going to invest based on a truce. They want a peace deal, and that hasn't come yet.
What can you point to in our economy that warrants a cut by the Federal Reserve in July, when you bear in mind that just last week Jerome Powell said that the Fed's monetary policy will not be based on what he called short-term political interests? What is it that's going to prompt a cut, do you think, next month or this month?
If you look at the U.S. on a standalone, it's actually very hard to find reasoning. If you look at the U.S. in the context of a weak global economy, then this notion of an insurance cut comes up, Bill. But let me just warn people watching. The market has gone way beyond an insurance cut. The market is pricing in 4 cuts in the next 12 months. That's not insurance. That is a signal that there's something really wrong with the economy.
And do you see that? Do you see inherent risks in the economy that might warrant what the market is expecting?
I don't think that the economy itself will warrant what the market is expecting, unless you assume there's going to be a major policy mistake or a major market accident. The economy is still in a good place. Yes, it's not as strong as it was a year ago, but it is still significantly moving forward and distancing itself from the rest of the world.
You're one who likes to take the global picture of things and try and make sense of it as a whole. So we've got the geopolitical concerns in the Middle East that are pushing oil prices higher. We've got those yields here in the United States are at near 2-year lows. We've got the Brexit mess that's going on in Europe right now. The trade tensions between the U.S. and China. Where are we globally right now? Are we seeing a meaningful slowdown economically, do you think?
Yes, we are, and Europe in particular. I mean, something that has flown below the radar screen today is what happened in Germany. German 10-year yields ended at minus 36 basis points, almost minus 0.5%. Why? Because the manufacturing data that came out overnight, they were horrible, Bill, absolutely horrible. And I worry about Europe. I worry about stall speed economies in Europe. And that's what's keeping our yields down. I'm all with your introduction. Go and refinance, because you're really getting a gift from Europe at this point in terms of downward pressure on our own yields.
Indeed. Mohamed El-Erian with Allianz. Again, thanks for joining us tonight, Mohamed.
Thank you.